Hey friends, Lucian here with the Bullish Bears team. Wanted to make this video on the kicker pattern. There's bullish and bearish kicker patterns. And the kicker pattern is essentially a gap up or a gap down. So you'll see right here kind of a smaller red candlestick and then a bigger kind of green candlestick. So it's a kind of jump starting or kicking off, thus creating a gap, which these gap windows right here, if you see these lines, are major. Let me zoom in here. Go back right over here. Support and resistance levels, right? So when a stock gaps up or gaps down, it's going to create support and resistance. So kickers are essentially gaps, right? Stock gaps up or gaps down. And I'm going to read you the definition. I'll show you more examples of it. But again, if you want to call a gap, a kicker, a gap, whatever you want to call it, don't overthink things. Again, if you haven't been watching our videos yet, we've been doing a major candlestick series that we're going to put into 2 huge courses on our website for free. So if you haven't been over to our website yet, head over to bullishbears.com and look out for our 2 candlestick courses that we'll be launching. This video will be a part of it. We'll have a basic candlestick course that starts off with more of the basic patterns, and then kind of leads you into the more advanced patterns and the reversal patterns. So stay tuned based upon when you're watching this video for our candlestick courses. So again, like we usually like to use this resource, investopedia.com, very handy for the definitions. And then again, we like to show you several real world examples. So a kicker pattern is a 2-bar candlestick pattern that is used to predict a change in the direction of the trend for an asset's price. This pattern is characterized by a very sharp reversal in price over the span of 2 candlesticks. Traders use it to determine which group of market participants is in control of the direction. Breaking down the kicker pattern, this kicker pattern is deemed to be one of the most reliable reversal patterns and usually signifies a dramatic change in the fundamentals of the company in question. To traders observing the kicker pattern, it may seem like the price has moved too quickly and they may wait for a pullback. However, those traders may find themselves looking back and wishing they had entered a position when they originally identified the kicker pattern. So, long story short, again, nothing's always perfect. Many a times you'll get a chance to get in, and then sometimes it goes a little too quick where you can't get out of it. So this one right here with Netflix, you'll see a big jump up. You see many of times it's followed by some bigger volume. So actually, I'm sorry, this is actually a different gap up right over here. The one I was looking at over here, huge in volume. So you'll see the the gap right here, right? So prices down here, hugely gaps up. This did have a little bit of a pullback before kind of one more jump up. You'll see kind of that bull flag over here. And then it kind of reversed. And then again, this window, right, where it gaps up, then becomes support. So jumps up, support level right here. And then when price falls below it, you can see falls down into this gap, right? See this window, right? So it creates the kicker, creates the window, and then it trades inside, right? Inside the gap. And then that support level now becomes resistance. Again, gaps, so incredibly important to pay attention to. So the kicker creates this gap. Usually, or many times, it's based upon either good news on the way up or bad news on the way down. Not always, but typically. Let's look at several other examples over here. You can see, we'll take a look at AT&T. Another one right here. Big jump up, had a lot of volume, had another green candlestick up over here, some volume. So you could have traded that, and that was a big jump up. And obviously, see, these moving average lines are extreme support and resistance levels, and then obviously gets up to the 200 SMA, and then naturally wants to gravitate back down to the moving average lines, right? Stocks are like rubber bands. If they get too far in one direction, either overbought or oversold, it naturally wants to gravitate back to the moving average line. So it's so incredibly important to use these candlesticks patterns and then use them in conjunction with moving average lines. Understand candlesticks first, then layer on moving average lines and understand how these candlesticks are moving in relation to the moving average lines, right? Let's take a look at several more examples here. I'll show you some bearish ones as well. If I kind of zoom in over, where was that? Right here. Bullish kicker, gets some good volume here, jumps up, right? Creates this gap. And then obviously in the future, look down over here, then becomes support. Gaps up, price comes back down, tests the gap, comes down, fills the gap before potentially going back up. There's a saying that all gaps must be filled. Again, it's kind of a matter of when it happens. So just because price gets close to a gap doesn't mean it's going to fill it. So I mean, if a price gaps up, usually it wants to come back down, fill that gap back down again before it goes back up again. Or if there's a gap down, price many times will go back and fill the gap up either before fading or going up further. Let's look at some bearish kickers as well. And let's look back over here. You'll see these all over the place. These windows, they're also called, so they're called gaps and they're also called windows. So you'll see that this gap right here that you see this area, right, the space in between, it's also called a window. So a gap up is also called a rising window. A gap down is also called a following window. And then the candlesticks that make up the windows are called bullish or bearish kickers. As you can see over here, price drop down here. You can see some big volume, thus creating a gap. Price falls down. What's it want to do? It naturally wants to gravitate back up to the moving average lines. It rejects off the gap here, falls back down, goes back up here again. It's in the gap. Now the gap is filled. What does it do? It comes back down and retests it before going up. So many times it'll retest before going up, and then also many times it fails, right? Again, it's so important to understand patterns, and those gaps are incredibly, incredibly important. Support and resistance windows. You can see down over here, here's Citigroup right here. You can see this gap down, falling window, part of a bearish kicker. So big bearish kicker, big red volume, price falls back down. What's it want to do? Wants to gravitate back to the moving average lines, but it's got to deal with obviously this gap first. Price gets into the gap, doesn't always fill. See, you can see, many times it fails when it's in the gap before making another run up. Kind of tests it over here, creates some indecision before it goes up. What does it come back do? Comes back down, retests it. Many times it fails before going back up. You can see these gaps are just so incredibly important, and they pay just close attention in the future. Right now, prices obviously on Citigroup has been trading way above it. Eventually, maybe it'll come back and retest those areas, but that's why support and resistance is so incredibly important to be aware of. And we'll take a look at GDX. You can see this gap right here that's created, gap down, bearish kicker. So the candlesticks, it's dropping down, and got the volume here. Price falls back down, gravitates back to the moving average lines. What's it do? Starts creating some indecision right around the gap, goes and fills it, kind of gets a little crazy, jumps back above. What's it do? Comes back down, and look at all this, right? Again, no coincidence that this is happening. These windows cause really important support and resistance levels that traders are very, very well aware of, right? You'll see them just over and over and over again. You'll see here's a bullish kicker on Twitter. Look at this, happened right at a moving average line, right in between all the other moving average lines. You'll see this kind of this spinning top or a doji right off of the 200 SMA. Got a major kicker above, got huge volume, and again, created this window, right? So this is a bullish kicker. The reverse is a bearish kicker, resulting in a gap up or a gap down, otherwise known as rising window, falling window. Again, take our courses. We explain all of these patterns. But again, many of times, these patterns are really essentially telling the same story. I like to make the videos and put them together for you guys so you can know the differences and also know the similarities, because again, many of these patterns are just very similar. So if you aren't a member yet of our community on Facebook, come and join us. We are the Bullish Bears. We run a very large community, very safe community to learn the stock market, so feel free to come and join us. You can like and follow our fan page as well. If you haven't been over to our website yet, head over to bullishbears.com. We have a live day trading room and a swing trading with options room. We do trade alerts as well. We have a few $1,000s worth of free courses, soon to be adding in a couple major candlestick courses, which are going to be the glue to our other courses. None of these other courses matter unless you know candlesticks first. We cannot stress enough the importance of candlesticks. Candlesticks form important patterns. Those patterns form very important support and resistance levels, and it's all about knowing support and resistance when trading, knowing when to buy low and sell high, or if you're shorting, sell high and buy low, right? These patterns are super, super important. And if you are not a member yet of our community, you can come and join us. As you can see down over here, we are only $10 per month. We make trading affordable for pretty much everybody. We are a no pressure trading community. You can come and join us, practice trading in a virtual account for months, up to a year if you'd like. There's no pressure with huge monthly payments and membership fees like other trading companies cost. Again, we just make it just very simple. Kind of sit back, relax, come and practice, learn from other traders, practice making paper trades until you're feeling really comfortable, and then start scaling up to real money when you are having good results trading in your virtual account. So hopefully this kickers video helped you and our candlesticks courses help you, and we will see you in our community. Enjoy.